We have to understand what does it mean to have a central bank digital currency. In the current financial system, the only institution that have access to the balance sheet of the central bank, that have an account with the central bank, like a bank account, like a deposit account, are only commercial banks. And the whole system of interbank payment system occurs through essentially the commercial banks have accessing to reserves and excess reserves with the central bank. And therefore transfers of money and liquidity across banks occurs through this federal funds market, this the interbank market for the commercial bank linked with the central bank. So if you are an individual, like a household or a worker, you don't have a bank account with the Fed or the central bank like the ECB. If you're a corporation, you don't have a bank account with the central bank. So only commercial banks have access to the balance sheet of the central bank. And therefore, whenever you want to make payment in the private sector, if you are a household, if you're a worker, if you're a non-financial corporation, you have to use the commercial banking system. You have to use bank deposits, checks, wires, and the connected digital payment system that exists right now, like Venmo and PayPal, that are still linked to your bank account. Now, suppose you create a central bank digital currency. That means that every individual in a country, not just commercial banks, but literally every worker, every household, every business, every corporation would have access to the balance sheet of the central bank, could have a deposit with the central bank. So when they make a payment, me to you, I don't have to use a bank deposit, but I can transfer money from my account at the Fed to your account at the Fed. So the entire payment system could be based on the central bank for private transaction of money, for payments of goods, services, and financial transaction. So that's the innovation. Now, when people talk about central bank digital currency, the supporter of crypto and blockchain become very excited, and they say, you see, even central bank are going to go to crypto and blockchain. But the reality is that if this central bank digital currency were to be created, they're not going to be necessarily on a public ledgers based on a trustless system or a permissionless system, just the opposite. They will be not based on blockchain or crypto, they will be centralized, there will be a private ledger, they will be trusted and verified by trusted institutions like the central bank or commercial bank. There will be permission rather than permissionless, and therefore talking about central bank digital currencies and thinking of them as being Bitcoin, like being crypto or based on blockchain, doesn't make sense. They will be based on a system that's completely different. It's actually centralized as opposed to being decentralized. Second point is that if and when a central bank digital currency does occur, potentially this is free, is instantaneous, is cheap, is safe, is secure, and therefore a central bank digital currency could dominate all types of private payment system, including bank deposits, wire transfers, checks, cryptocurrencies that of course are not even means of payment, and could also dominate the new fintech digital payment system like Alipay, WeChat Pay, PayPal, Venmo, Square, and so on. So literally you could be in a situation in which the entire payment system occurs through the central bank rather than through private forms of money like bank deposits or digital payment system. That leads then to consideration of two types of financial stability risk that you have to worry about if you have a central bank digital currency. Risk number one is that suppose there is a crisis and there is a financial crisis, and in addition to the digital currency, there is still some deposits in the banking system. Then if households feel their deposits are not safe, they may take their deposits from commercial banks into the digital euro or dollar. So you have a bank run, and you can create more financial instability. So you exacerbate the risk of a run from commercial banks into the safe digital currency of the central bank. That's one risk that you have to assess. If you're having a central bank digital currency, it's safer than deposits. And the second one is that you have a disintermediation of the banks in a fractional reserve banking system. If you think about it today, banks collect your deposits that are short-term overnight, and then they intermediate them by lending them longer term to corporates and other businesses of one sort or another. So banks are in a fractional reserve system where they have only limited amount of liquid assets. Most of their assets are loans, and most of the liability of the banks are shorter term, if not overnight deposits. If those deposits are going to disappear because everybody's going to use the central bank digital currency, how do you have to change completely the financial system? First, you disintermediate the banks from this maturity transformation. Secondly, you create a narrow bank that is a central bank that does all payment systems. And then the traditional commercial banks become essentially loanable fund financial institution that instead of borrowing short-term and lending long-term, they have now to borrow longer-term to finance long-term investments. So they are not the traditional banks that are doing the maturity transformation by having overnight deposits and long-term loans. So you completely radically change the financial system, and that transformation actually has significant implications, some of them positives, some of them negative. The positive may be less risk of credit and asset bubble, the negative massively disintermediation of the financial system and creating a completely different financial system. So that's why central banks are cautious about the idea of going to a central bank digital currency, because you may exacerbate financial instability by having bank runs and by disintermediating on a permanent basis commercial banks in the maturity transformation and in essentially using short-term loanable funds to do long-term lending and investment. Now, there is